Hi, it's Matt and Rebecca. Welcome back to Building What Matters, the podcast where we talk money and making your future a little less scary. Welcome, Beck.
Thank you. I'm excited for this one.
Yeah, simple but important.
Yeah.
One thing that we always talk to our clients about is that to get ahead and achieve your goals, investing is mandatory. I want to leave things like property to the side because they're another conversation. But when it comes to investing smaller, starting off, and companies, shares, what are the options, Beck?
Yeah, I think taking a step back is really important. That Australia's come a long way, and I think we do actually accept now that we need to invest to get ahead. Like, we can't save our way to good fortune and wealth. So when we think about investing, you're like, cool, I need to do this. And then you go, oh shit, how do I actually do this? So when it comes time to actually making choices, people think that they need to go out there and buy some shares. Maybe they've heard of things called an ETF, an exchange traded fund, or they might have heard of something like a managed fund. They're really, outside of property, they're your three key options for starting with investing.
Great. One thing I really want to make sure people are clear about as well is that there's different platforms, there's different providers, there's even different tax environments that we will come to at another time and another place. But for right now, we're talking about the end investment, what you see on your statement. That's what we're talking about.
That is what we are talking about. You're so right, because you could actually spend all day talking about this. Like, there are literally books, entire books on different ways of investing, and it's just going to blow your head up.
One thing you mentioned a moment ago, and going completely off track here, but you said that Australia's come a long way. Compared to what?
I feel like when I started my investing journey 15 or so years ago, like, you were out on a limb if you were a young person wanting to invest. Like, I remember talking to my grandparents and they got me their stockbroker, and it was like there was a lot of paper involved. It was a big deal. And now everyone seems pretty chill about it. Like, a lot of new clients, when they come to us, they've already been dabbling in ETFs. They've been reading books. They've been listening to podcasts. Like, just communally, I think we've come a really, really long way. We may not be executing on the concepts, but we are well aware of what the concepts are.
I agree. And I'm always interested about the Great Australian Dream and what impact that might have had on how long it took us to get here, but also going really broad, how much of an impact globalization has had. If I think about all the things that you see, read, and hear anecdotally about Americans, they are the complete opposite. It is absolutely ingrained in them to invest often, early, and consistently along the journey. But then I'm really unsure how we got here, where your grandparents, like mine, my grandparents weren't super wealthy, but they had a stockbroker and they had their BHP, they had their Rio, and they had their four banks right through to the day they died. But then I don't think our parents' generation was anywhere near as connected, nor us.
Yeah, I reckon you're actually onto something there. And sorry, did you not know that diversifying means you just get one of each of the banks? That's how you do it.
Yeah, because Paul up the road, he has a Westpac account, and that's diversing against my ANZ shares.
Yeah, exactly. I think that's a really interesting point, and probably beyond the scope of what we have time to talk about today. But maybe it does come in with like the rise of property and what a role that has played in like Australia's wealth creation. But you can see it in, whether it's through the research or through just communication and conversations as well. As younger people, so I'm talking like Gen Zs and Gen Ys, are feeling less connected with property. That is also going hand in hand with the rise of investing in shares.
Okay, so I've got to the point where I know I need to invest.
Great. We love that. First of all, well done.
Perfect. How do I execute? And I'm reading on one side of the fence this playbook around Index, Vanguard, BlackRock, and then on the other side, people swear black and blue that they need to do active investing and they can beat the market. Firstly, what do those two things mean?
Okay, so we're talking about two key concepts. We've got active and passive. So passive is when you are buying what the market is doing. Like, this is not going to be a textbook answer. This is just from the brain of Rebecca. So you're buying a basket of securities like following the top 100, top 200, top 300 companies in Australia or the US or a market, and you're just following what they're doing. So you're saying, cool, I'm in the market, I'm along for the ride. I'm not trying to be smart, I'm just there. Market goes up, I go up. Market goes down, I go down.
And historically, companies get bigger. You own a higher proportion of the bigger companies from your investment.
Correct. So your big dogs at the top end of the market are going to be a higher proportion of your portfolio. The little guys at the end just going to be around the edges.
So if I was using an Australian version of the index investing, funnily enough, a bit like my grandparents, I would have a pretty high proportion of BHP, Rio, Telstra, probably all the companies that you see advertising.
Yeah,
and
we
then
call
the
them blue
banks.
chips, right? Like they're ones that you would be familiar with.
Cool. And as I go down that path, what are the benefits?
Okay, so the benefits of that is, as a consumer, you are not thinking, right? Somebody else is organising the shopping trolley of these assets. You are able to be diversified beyond the scope of our grandparents, like genuinely diversified across, different sectors within an Australian market, international market. It's pretty cheap to do it, pretty easy. You kind of just need to pick an option and get going.
I know you've put a ban on me putting footy references in here, but as the great John Kennedy once said, don't think, do.
Yes. Yep. Look, I'm sure Yoda said something similar. So it is a very accessible way of investing. So we're using the word passive. People might have heard the word index, or just, I think ETF is used sort of in a homogenous way to describe this style of investing. I like it when people go, I'd like a Vanguard. And I'm like, what do you mean by that? They're like, okay, I actually just want an ETF.
Yeah.
I want a passive style investing. I'm not trying to get cute. I just want to go for it.
Cost,
yes. So there's always going to be options, and there has been billions and billions and billions of dollars going into this style of investing over the last couple of decades. As that happens, more options pop up. So you have like an array of costs, but generally speaking, let's just keep it simple. It's pretty cheap.
Cool. So on the flip side, and bear in mind, we are not objective here because Rising Tide is an index/passive.
We like passive.
Philosophy is where we live. And a part of that comes back to our belief around value. On the flip side to index, you've got active investing. Can you give me a high level understanding of what that means and what the pros and cons are?
At a high level, it's saying I'm going to be smarter than the market, right? I'm going to be active. Like I'm not going for a walk, I'm going for a run. It's saying I'm going to look at the available options in the market. So again, let's say Australia. I'm going to pick the ones that I think are really good bets. And my expectation is that I'm going to outperform what that passive portfolio that old mate over there has got. And I'm going to make more money.
And effectively, part of why you are paying more, which you do pay more for, is that it not only has more thinking involved, it also has more action and more consequence.
Yep.
Because what we know with investing, and one of my favourite ones, the more you touch, the smaller it gets.
Yep.
A bit like soap. So people are touching it more. They've got to make more decisions. They've got tax consequences. They've got a whole lot of things that you got to get done.
Yep.
But people will swear black and blue that is the right way to go about it.
Absolutely. And if you think about like the possible outcomes of the market, right? If we're going for a passive portfolio, maybe for a high growth portfolio, you might be saying on a really rocky year, negative 20% through to like positive 30%, right? That's a reasonable array. It's still a big array. With an actively managed portfolio, you are expecting more upside. You are less diversified. You're taking on perhaps a bit more risk. You are definitely paying more. Like you will not find an actively managed portfolio that can compete on cost. And so your expectation ought to be that this portfolio should do better. What's really interesting is that the academic research really consistently shows that it's between 1 in 4 and 1 in 5 portfolios that does actually outperform a passive investment option, which they're not great odds. which is fascinating, I think, given the size of the actively managed market in Australia, when the research really doesn't add up.
I think from a rising tide perspective, we firmly believe that there are fundamentals that you need to do to get right, and overcomplicating things can impact the decision-making process, decision fatigue, but also from an understanding point of view for our clients. We know that when they understand why and how things are working, it makes things a lot simpler.
We even take the last 12 or 24 months. Like last year, your minerals and your resources stocks were absolutely flying and tech was getting obliterated, right? 2026, it's completely inverted. And who the heck knows what 2027 is going to do? So the nature of passive investing is saying like, I'm not trying to anticipate what happens next. I'm just following along, and I'm going to take my wins and I'll take my ups and my downs along the way and over the course of a long period of time, because that's, again, part of the philosophy. If you're a high growth investor, you're investing for 8, 10, 15, 30 years. You, on average, are going to come out looking really nice, but it's going to be a bit choppy along the way.
The first probably 8 to 10 years of Rising Tide, we used multi-manager, active, which was great for diversification. But one of the things that really changed my mind around moving from active to an index style was what you just alluded to. It was a chart called the Chaser, colloquially. And it was basically what the different asset classes had done year by year, and effectively no correlation between what does well one year versus the next, yet there was a high correlation of where some of that active management led to, which I suppose is human nature. You know, we see things, follow them, as opposed to what we're talking about from an index point of view. You make a decision at the start of your journey and you don't get swayed.
Yeah.
Now, there's certainly some things that need to happen along the way when it comes to risk appetite. Absolutely. And how you invest and the tax environment you do it in. But effectively, what we're saying is that we want to remove the thought process once we've committed to the investing journey, right?
Yeah, and again, if we think about like what the appetite of the Australian person is doing and has changed, I think we've seen a lot of progression in terms of people's understanding around what fees do. And so keeping fees pretty low cost, particularly when you're starting small, is like a really healthy like vitamin boost for your portfolio and helps it to grow over time. It encourages you to not to chop and change, because again, you're not trying to outsmart the market. You're not like, oh, okay, my portfolio's had a bad year. Is that because my manager sucks, or is it because of A and B reason? Am I waiting for this other catalyst to get like that's like, where do you stop? Where do you draw the line on that sort of analysis and head spin?
I love that. Reflecting back when we were advising clients during the GFC back sort of, 2007, 8, 9, and our clients were in active portfolios, there was significant differences between the different portfolios, as opposed to, I fast forward to the two times that, in recent history for us where the world has had an impact would be the start of COVID and then the most recent war. And for me, as I'm thinking about our client content, our communication, let alone how we're preparing to have those conversations, to go, your portfolio is absolutely where we would expect it to be based on the world.
Yeah.
Not going, well, the world has an impact, but then manager number 1, 2, and 3, they've underperformed what should be happening. And I love that for clients. Finally, just on fees, I think it's really important that we can provide people a bit of an overview of the types of fees when it comes to investing. From my point of view, I always like to keep things pretty simple. You've got your platform fee. So the businesses that people might have heard of, it could be the super funds, it could be Hester, it could be Net Wealth, any of these, they charge a fee to do the work. And then there's what we're talking about. So it's either the active managers or the index managers, they charge an investment fee. And then there's the advice fee. What could the difference be between some of those, and what potential impacts can that have on someone's returns?
Oh, where do we start on that one? So I think it's really encouraging that in recent years, most of the admin fees are moving towards like flat or flat-ish capped fees. So that's like a ticket to the game, right? Like imagine going to the supermarket, it's like to get your trolley, you pay a fee, which I think is pretty fair, right? You know, you're asking someone to provide you a service, you pay for that.
And there is people involved, significant
Totally,
compliance.
tech compliance, when something goes wrong, you want that business to help you and probably pay.
Yep.
So that's what your admin fee is paying for. Fair game, I say. Investment management fees would be percentage based. So it's going to be directly, the amount of dollars you pay is going to be directly linked to how much you have invested. You have a little bit invested, you could pay a little bit of a fee, and so on and so forth. So gone are the days, thankfully, of like horrific 1-2% investment management fees. Like the market is too competitive now to see that. You would generally be thinking though, like I don't even know how you pronounce it, high noughts, like 0.7% through to like 1-ish.
Close to one.
Close to one, thank you. For an actively managed account or actively managed investment. For your passive funds though, like we are talking dirt cheap. Like I've seen like 0.05 through to like 0.1, 0.15, you know, depending on what it is you're wanting from the portfolio. Because there are, you know, there's still features and there's still different choices to make here.
But potentially Australia's scale and access to some of those bigger global players means that there is downward pressure on the fees.
And you've seen that in years, like there's so much money flowing in this environment. It's far more competitive than it's ever been before.
Now, when it comes to people who bleed black and blue and would say that active is a must, apart from saying don't come to Rising Tide for advice, what else would you challenge them on?
Yeah, I was going to say, great. I love that. Go for it. Understanding like what's the thesis? Like what are you actually trying to achieve with that portfolio? I don't think we have time to go into it today, but there are some circumstances that we would wholeheartedly agree with actively managed portfolios. Like if you are asking for a responsible investing overlay to your portfolio, you are asking your portfolio to do something more than just follow the market. You need brains, you need expertise, and you should pay for that, right? So understanding what it is you're trying to achieve will help you work out whether it's the right fit. There are the rise of these things called like thematic funds in the last 5 or 8 years. So it's like really niche ETFs that have popped up. So if you want to have a crypto ETF or a software ETF or whatever it might be, like there probably is something if you're really excited about a certain sector that you'd like to invest in, there probably is an ETF that fits the brief. But I think the key question, I mean, literally we could just copy and paste this over all of our episodes, Matt. It's like, why? Why are you doing that?
For me, if it's really clearly going to help you achieve your goals and there's no other alternative, then go for it. Have good conversations with people that know what they're talking about. Probably not me in that regard.
No.
But equally go for it. Beck, thanks for being here again. If there's anything else you want to cover off regarding this, let us know. Head to our website, click the book now button if you want to lock in a time to chat with either myself or Rebecca, and we look forward to seeing you then.
See you soon.